Good morning, everybody. Welcome to the Kensington webinar on the impact of the mortgage market and lender funding of COVID-19. I'm Craig McKinley, the new Business Director for Kensington, and I'll be joined today by Alex Maddox, our Capital Markets Director. So in terms of agenda, what we'll talk about today, we'll talk about the very dramatic and very fast impact on the market that we've seen so far from the coronavirus crisis. We'll look at the different types of funding that lenders have and what this has meant for that funding and the impact of that. We'll talk about what this has meant for lenders and for the market and supply to brokers and customers. And then finally, we've just got a couple of slides that talk about Kensington's position and the approach we're taking and how we're trying to get through that. So what's happened? Well, a huge amount in a very short period of time, frankly, as I'm sure you're very much aware of. We've had 2 Bank of England base rate cuts. So Bank of England base rate down to the lowest rate it's ever been, going from 0.75 down to 0.1% over 2 cuts in the last few weeks. Huge government stimulus programs, all sorts of activity. The government only allowing critical house moves, so typically customers who have already exchanged and then potentially have some potential of detriment if they can't move. Otherwise, government very much saying you shouldn't be viewing houses, you shouldn't be looking to buy houses. So that obviously makes it hard, and even for the people who do want to continue with the move, potentially that's quite difficult, getting removal men, etc. So big squeeze on house buying. Things like furlough and self-employed government schemes. I mean, furlough is something I'd never really heard of before, apart from when the American government shuts down periodically. And that now seems to be part of daily conversation and parlance. And this is something we've never really experienced in this country. So that's something new that we've all had to get to grips with very quickly. Payment holidays offered for homeowners and landlords, again, something we've not seen before. Huge impacts for individuals, for lenders, lots for us to deal with in a very short period of time. Physical valuations being put on hold. Again, for businesses like ourselves who don't currently do AVMs and desktops, that's a massive impact. And I think every lender's been impacted by that significantly, because not everybody does AVMs, and the people that do it don't do it on all their product ranges. Scottish Land Registry changes. So we had the Scottish Land Registry are not working at the moment, so very hard to complete a case in Scotland. Looks like there's a interim solution there, but again, that's a big impact for the people of Scotland. And then repositions and evictions putting on hold as well. So all very sensible measures, but all a huge amount for us as lenders to digest, you as brokers to digest, for your customers to understand. Just huge flurry of news and activity in a very short period of time. So in terms of what's happened as a result of that, the impact on the market, well, as you'll see, lender criteria is changing daily. I get a roundup email every day, which just gets longer and longer. Huge amount of mortgage products, about 50% of mortgage products have been withdrawn from the market in a 3-week period, which is unprecedented. When we saw similar things in the financial crisis, it certainly wasn't over such a short period of time. And you can see the 2 charts at the bottom of the page really bear that out, how I mean, the charts there are really there's only about a 2 or 3 week period, but you can see how steep the dive is, the total amount of products in the market dropping by about a third in the mainstream market over a 10-day period, and about 40% in the specialist market over a similar period. But now that's now about 50% of products have disappeared from the market. Lenders are receiving thousands of calls per day on payment holidays, which they're just not set up to take. So I saw Alison Rose from the CEO of RBS and NatWest interviewed last night, and she was saying their call centres have gone from 2,000 calls a day to 25,000 calls a day. Now, nobody is set up, no business is set up to have 10 times the demand. I mean, we've seen supermarkets struggle with kind of double the demand. So that's been very challenging, and unfortunately has meant that customers have long delays, there's huge email queues, there's big abandon rates, etc. And that's very difficult because we also know those lenders also are struggling to get people to work from home. So not only have they got this huge inflow of call volumes, they've also got people who are off sick, people are looking after children because the schools are shut, people who can't work from home. So it's a bit of a perfect storm, really, in terms of supporting those customers. And then, of course, we've seen lenders responding to the valuation solutions, whether that's stopping lending or limiting their product ranges. So a good example there would be most lenders aren't doing new build. The only lender I've seen that says they can do any type of new build at the moment is currently Nationwide, who have said if they've been to that site recently, they might use some of that intelligence. Pretty much everybody else has said they can't progress with a new build case. They might take it at application, but they can't progress anywhere until they can do a physical valuation, and who knows when that will be. We've talked about solicitors unable to complete purchases. And then pipeline cases are reducing, so purchase chains understandably are collapsing. People are asking for 3-month offer extensions, big changes in customer circumstances, and what does it mean if you've been furloughed? What does it mean, obviously, if you've lost your job, people not actually being able to move house, even if they want to move house. And then, lender capacity issues with people being off sick. Huge amount of problems with people working from home. So, we're a relatively small lender. We've got 500 people. We're relatively agile and nimble. So we managed to go from 0 servicing people being able to work from home to 300 servicing people working from home in a week, because we just went out and bought 300 laptops and all the kit they needed. Much harder to do if you are a big lender with thousands of people. And of course, much harder to do if you are a lender who has offshore call centres in places like India, where they've all been sent to work, sent home, and they can't work from home. So huge issues there around lenders being able to support customers. And then also from the supply side, from a lender's perspective, is the amount of brokers not working. We've seen some of the big estate agency groups furloughing up to 75% of their staff. So there's a huge amount of brokers who aren't working. Those customers are effectively orphaned because the broker's not supposed to be working. We've seen redundancy, etc. And of course, all this has happened in such a short period of time, which has been very dramatic and surprising. So I will now hand over to Alex to talk about funding, the different types of funding in the market and how they've been impacted by these changes.
Thank you, Craig. This is Alex Maddox. As Craig said, I run our capital markets function here at Kensington. You may or may not be aware we're one of the most frequent issuers of RMBS in the UK market, really since 2015, when ownership of Kensington changed. We've issued about £10 billion, and probably 50% of the RMBS that's linked or that's been issued by specialist lenders has come through the Kensington programme. I'll refer to RMBS and securitization, maybe even ABS, sort of throughout this. They kind of mean the same. Obviously, RMBS is a type of securitization, a residential mortgage-backed security. But as I say, I'll probably use the terms interchangeably, so apologies in advance for that. So if we go through to the next slide here, I've set out the different types of funding that are available to both banks and non-bank mortgage lenders. And if you look at the left-hand side, I've split this page into the wholesale funding options and the retail funding options. Within wholesale funding, in terms of the available financing instruments, covered bonds and securitization are the two most common for the mortgage lenders and for funding mortgage portfolios. And in the retail funding side, I would say probably fixed term accounts are the most common for the specialist mortgage lenders because they don't have current account capacity like the mainstream lenders will. So, current accounts would be key for the big high street lenders, but for Kensington's peers who are banks, it would be more the fixed term accounts and the saving deposits. In the middle, I've looked at the current funding conditions with a fairly standard sort of red, amber, green colouring. Blue is just added there to show that there's just one area where funding conditions are increasing or improving, and that's sort of with central bank funding from the BOE and a couple of other programs that I'll talk about in a minute. But as you'll see there, that whilst the retail funding options are all sort of operating fairly normally, it's really within the wholesale funding market, so the capital markets, where there is a sort of a challenge, or at a minimum the activity is patchy in the market. If you look at the far right-hand column in terms of the financing instruments that are available for non-bank lenders like ourselves, you can see that the three that have the sort of the green yeses there, when you look across to the current funding conditions, all three of those are challenged right now, and I'll talk about that in a bit more detail later on. But obviously that that does mean that the funding models for the majority of the non-bank lenders are challenged right now. Government has stepped in, as you can see on this slide. Craig mentioned a few of the initiatives for customers, the moratorium on repossessions, and also some waiving of fees for arrears charges are also on that page there. I think one important thing that I'd add on the customer initiatives, which is linked to the capital markets and the funding, is that it's been very clear from government and from the regulators that any kind of payment holiday should not be treated as an arrears from the customer's credit file point of view, and we fully support that. But that's also the case in terms of how we're reporting the arrears status on our loan portfolios to our capital markets investors. So in a securitization transaction, we'll typically send out information on a monthly or a quarterly basis telling our investors how the collateral pool or the pool of loans is performing. They won't see the payment holiday numbers coming through in the arrears, and there's a lot of work going on in the industry to try to find a good way to pass on the information about payment holidays to the investors in the capital markets. As you can imagine, those investors are desperately seeking any information they can about the level of payment holidays in the market. I'm sure you're all watching the information out there, and Craig talked about the number of phone calls that lenders are getting, and a lot of that will be from customers either looking to take out payment holidays or interested in knowing more about payment holidays. So really a very important part of that initiative is how it gets treated in the capital markets. If we turn to the right-hand side of this page, the initiatives for businesses, the Term Funding Scheme, or TFS, then the CCFF, and then the CBILS, which is the bottom one there. I mean, of the three here, I think the TFS is very similar to what was offered immediately after the Brexit referendum in 2016, a very substantial facility at 200 billion and very attractive funding rates, effectively at the Bank of England base rate flat. But currently this is only available to banks and building societies, and there's a bunch of rules in terms of who can access this, but broadly it has to be banks and building societies that are part of the sterling monetary framework. So for non-banks like ourselves, we don't have access to that particular facility. The CCFF provides a facility to issue short-term commercial paper. The majority of specialist lenders, non-bank specialist lenders, would not have that capability, so less useful for us. And then I think the final one there is the CBIL scheme. This is potentially interesting, particularly after the recent amendment to this scheme, which allows the slightly larger institutions to access this via the British Business Bank, but the maximum capacity is 25 million per lender, so per borrower. In this case, we would be a borrower. So whilst this may help in terms of working capital and operating expenses for lenders like in the non-banking sector, it really is not going to support lending in the same way that, say, the TFS can do for the banks and building societies. If we now move on to the sort of typical funding model for non-banks, almost all non-bank lenders use a similar structure. So I'll just talk through the first step here is that the lender will transfer mortgages into what's called a warehouse or a warehouse line. These are typically provided by the big banks. We listed a few there in the first bullet point. But these do exactly what you'd expect them to do with a name like a warehouse, and it's really a temporary storage facility for the mortgages until we get up to critical mass, typically sort of £300 million in a facility. So for some smaller lenders, that will take 6-12 months. For larger lenders like ourselves, it can be a matter of a few months. And then once the warehouse has got to its sort of target capacity of around 300 million, then the loans will be transferred into securitisations. The banks will be repaid the money that they put into the warehouse, and instead public investors will provide the funding against the mortgages. Now, those public investors could be pension funds, they could be asset managers, and the big sort of global and local asset managers, and it could also include bank treasury departments. But that's a key part of the process, is that placement into the public markets. Now, this is a chain in the same way as a sort of series of property transactions are as well. So if any one point of this chain is not functioning correctly, then it becomes a challenge all the way along. So right now, the public investors are not buying or investing in securitizations in material amounts. It is improving. I'll talk about that a bit in a minute. But that part of the chain is challenged right now. So what that means is that the mortgages that we have in our warehouses are staying in there, and we almost have the opposite problem of the supermarkets, where our warehouses are beginning to get heavier and heavier with supplies and mortgages, whereas obviously the supermarkets have empty shelves in their warehouses. So depending on the type of lender you are and the size of the warehouse you have, it will determine how much additional capacity you have for lending while you wait for the securitization market to reopen. There are a lot of benefits of securitization. I've tried to set this out on this slide, and in particular, if you look at the diagram at the bottom of that page, what happens is we split the payments from the customers into the repayments in terms of the principal repayment and then the interest on the mortgage loan, and then ultimately the repayment from the underlying mortgages goes through and repays the public investors on the bonds that they own, and the interest from the customers is used to pay the interest on the bonds that the public investors own. So there's a real sort of benefit of this. If the customers slow down repayment of their mortgages, now that can be because they need to switch to a temporary IO as part of a payment holiday, or maybe because the rate of refinancing goes down. What happens is the repayment of the bonds also slows down. So the beauty of that is for lenders like ourselves, we only have to repay the debt to our public investors when we get repaid by our customers. And this is called it's often called match funding in the markets, and is a really important tool for asset liability management. The other thing is when we get the interest, if we don't get the interest from the customers, then we don't have to pay the interest through to the public investors. There's usually a first loss, or a sort of initial 5% of risk is taken by the mortgage lender to ensure there's alignment of interest. But after that, the risk is shared with the public investors, and that differs, say, from a bank that might be funded via deposits. If the mortgages, let's just say that the bank has funded themselves with 1 or 2 year deposits, when those deposits come due, the bank has to repay those retail depositors, independent of the cash flow they've received from their mortgages, and it's very much that can often cause a run on a bank. Whereas if you've got the match funding, then it's less of an issue. So on the next slide, we talk about funding costs and what's happening in the securitization market. And as you can see from the chart on the left-hand side, this is one of the key costs of the securitization RMBS. This is the AAA class, the most senior class. And you can see that spreads were generally coming down, and actually January was some of the best pricing we've seen in a long time. But that quickly reversed, and as you can see there, the funding cost has gone up by about 1.5%, so 150 basis points. It looks pretty horrendous on that chart, but if you look at the right-hand chart, which is a longer time series that includes right back to when the financial crisis happened in 2008, you can see that actually it's not quite so scary, and really we're still within a range that we saw sort of since 2011 to 2012. Other sectors, I mean, this market has stabilized. I mean, if I sort of showed you this sort of slightly updated now, it would have that blue line coming down a little bit, which is a great sign. Other asset classes have seen a more rapid stabilization and more of a correction. One of the key reasons for that is that those assets like corporate bonds and cover bonds are eligible under the big Bank of England and government quantitative easing scheme called the Asset Purchase Facility. But securitization and RMBSs are not. In other countries, you do have the sort of securitized products are eligible within their QE scheme, particularly in the European Union under the PEPP scheme that they have for quantitative easing. Also now here, I'll just a slide on forecasts of base rates, and there were a number of questions from you around what we expect base rates to do. And rather than using my own crystal ball, this is the market expectation. So we can use various market instruments to infer what the forecast is. And if you look at the bottom right-hand table there, the row that says Bank of England base rates, you can see the forecast is at 0 where those dashes are for the next 12 months, and it's only in 2 years' time that the Bank of England base rate is at 0.25. This chart rounds to the nearest 0.25%, hence it may stay at 0.1% rather than go all the way to 0. But I think the key thing there is that the market is forecasting base rates to stay lower for longer. Great for those customers out there on tracker rates. But what I'd also say there is the 2-year fixed rate is expected to stay the same or increase slightly over the next year or so, and then it will go up by about 0.5% to 0.75% in a couple of years' time. So really, I think the key message from this is that the market is expecting rates to stay low and for longer, and the key reason for that is that when the significant recession that the economy has been pushed into in order to deal with the COVID-19 crisis will need to be corrected, and therefore lower rates will be needed to stimulate the economy and get growth back to offset the 1 or 2 quarters of quite severe recession that we're likely to see. So with that, I'll hand back to Craig.
Thank you, Alex. So we've talked about what's happened in the market in terms of what have been the big changes with the government changes, with what's happened to product provision, etc. Alex has talked about the different funding models and what that means. So we'll now specifically look at what does this mean for lenders. So in terms of funding and operational constraints, we've split the lenders into 3 groups. There's the high street banks, so the big banks funded by retail deposits. You've got the specialist banks who have a banking license funded mainly by retail deposits, occasionally do a bit of securitization. And then you've got the non-bank specialists, which include ourselves, which are very much funded purely by securitization. So we all share the same operational challenges. So we've all got the same issues with we're unable to do physical valuations. Some people can do AVMs and desktops, some people can't. Excuse me. We've all got the same challenges we talked about with this huge increase in demand for servicing, conversations about payment holidays, and lots of lenders, thankfully not us, are struggling with their service centres because not all of their staff can work from home, or some of their staff are offshored, which gives them issues, so they don't have the amount of capability they would normally have. So that's fairly universal. And in terms of what this means for product provision, I think we've seen a tightening in risk appetites. We've seen some lenders restrict self-employed lending, have done things like reduce the amount or take no things like variable income for overtime, commission, bonus, etc. Make those kind of changes. You've seen a bit of a tightening of risk appetite and getting tighter on any adverse credit. Then also, I think there is a concern about house prices now and in the future. So one thing we've done, for instance, is withdraw our highest LTV products because no idea where house prices are going to be. But I think it's fair to say they could drop. I'm not saying they will drop, they could drop. And is it the right thing for us to be potentially putting a customer into negative equity? Is that a good thing for us and the customer at this point? And then in terms of funding, Alex has talked about if you're a bank, luckily you get the government funding and you get the decrease in the rates that you take from the Bank of England, which there's a fair bit of political pressure to pass that through to customers. But then for the non-bank lenders, we have had the closure of the capital markets. They're not technically closed, they're just very, very expensive, so effectively closed. And we've also got pressure from warehouse lenders about, across all the non-bank specialists, what type of lending are you doing? Are we happy with what you're putting into our warehouse? Do we want you to do much more, etc.? So the kind of issues we're facing with. And also, there is a challenge for us as a non-bank on cash, because we're getting a lot less cash coming in the front door because of the 3-month payment holidays, but we've still got a similar cost base. So I think that's why you've seen lots of lenders change either their criteria or their product provision, or as this slide shows, whether they are indeed continuing to lend at all. So these are mostly lenders in our peer groups. These tend to be most of the non-bank specialists, and you can see they've all now stopped doing any type of new acquisition lending. We're not in that position. We are still open for business. We're still taking applications. Definitely not business as usual for Kensington, but we are still writing business, and TML have reduced to buy to let. But everybody else, you can see Vida together went first at the start, and everyone else has stopped taking applications and stopped lending over the last couple of weeks, which has then meant that's also driven part of that huge drop in product provision that you can see there, 5,300 products in the market down to 2,800 products. A lot of that is because some lenders have exited the market completely. So that just gives you an idea of the impact this has had and how fast it's happened, because this really has happened over the last 2 or 3 weeks, which is quite extraordinary. So we'll now go on. We've got the last couple of slides, so I'll now hand back to Alex so we can talk about Kensington's response to this. So Alex will talk about Kensington's funding approach, and then I'll finish up with what we're doing in our proposition, and then we'll move to some Q&As.
Thank you, Craig. So with regard to oppositional funding, we are solely reliant on the capital markets, and so we do prepare for a temporary capital market shutdown as part of our annual stress testing. We do prefer that to stay an academic exercise rather than an actual exercise like it is right now. It's a bit like the disaster recovery schemes that we all have, and we've had to kick off. Obviously, it's quite unusual to put in place both an operational disaster recovery and also this kind of financial planning strategy as well. But there are a few key strategies that we've got there that I thought I'd highlight. First is we maintain a very large warehouse. As I said earlier on, with the securitization market being shut, the warehouse starts to build up in terms of capacity. And we also make sure it's a very long-term warehouse, because at some point some lenders may close the warehouse. Our current capacity is over £1 billion of lending, and the term is over 2 years. So really the capacity is there and in substantial amounts. In terms of the RMBS market, as I said, we are the most frequent issuer. We did our most recent transaction in January this year, which was about 650 million, so quite a large transaction. As I said, most trades are 300 to 400, but we saw a very large amount of demand from public market investors at that point. Well, we were actually able to use about 30% of those funds for what's called pre-funding, but basically what that meant was that we were able to fund completions in February and March through that securitization that we did in January. So it was almost like pre-funded some of the completions that we knew were in the pipe. So again, that took further pressure off the warehouse line. And then we also have a whole range of financial risk indicators that we monitor, and those help us to understand how we should be prioritizing the various uses of our cash and warehouse capacity. Having said that, I mean, the issuing a new securitization today would be very challenging and costly. We are sort of monitoring the market and waiting for the signs that we could put a transaction into the market. But in the meantime, we will continue to manage our financial resources carefully, and we're obviously waiting for the next level of clarity in the market of when we can go back to the securitization markets.
Great, thank you, Alex. Then the final slide before we just move on to 5 questions we wanted to answer was just talk about how Kensington are approaching this. So Alex has just talked about how we are approaching our funding in terms of how we're approaching our propositions, so what products and what's our processes at the moment. So we are working hard on finding alternatives to physical valuations. So we hope to have a desktop stroke AVM solution in the market in the next 2 weeks. We have a process agreed, so we just need to get some approvals and make sure and operationalize that process. But we're hopeful we can do that at the moment. Anything that does come in as an application just sits in the pipeline. What we are trying to do is get back to a position where we can go all the way from application through to completion. Probably slightly harder on purchase because people can't actually move, but for remortgage, for instance, we would go all the way through because we'd be able to do evaluation and we'll be able to move it through the whole process through to completion. So we're keen to be able to do that in the next 2 weeks, and we've pretty much got a solution there to do that. We have narrowed our product range, so we're currently at a 70 LTV cap for both residential and buy-to-let. I'm hopeful we can nudge that up slightly over the next 2 weeks. Our lending criteria broadly hasn't changed, so we haven't put restrictions on people like self-employed. We're still, self-employed's always been a key part of our business, and we have a very flexible policy that allows either self-employed or employed people to deal with complex incomes. That's kind of what we do. We also have our hero mortgage, which is very apt at the moment for emergency services who are, on the front line currently doing an amazing job. So good that we can do something to help those people. But what we haven't done is put any credit restrictions around. So we haven't said if you're in this type of industry, we won't take your application, and we haven't changed any of our criteria. And then we're also finalising policy changes to reflect the current market conditions. So how we treat furloughed customers. So I'm hopeful we can move to a position where we will accept furloughed income, because I've seen some lenders have said they won't accept it. We are planning to accept furlough income, and I'm hoping we'll also be able to accept income above the government furlough. So for instance, if an employee earns £50,000 and the company says they'll top up the 30,000 from the government to £50,000, then I'd hope we could take that £50,000. So we're just working through that policy. And we're also looking at what we do post-crisis. So how do we treat people who have been furloughed and back to normal? My expectation is we will kind of ignore the furlough period and we will treat them as, whatever their income is. So if they go back to a normal income, that's what we'll look at, say hopefully in June or July, when hopefully we go back to normal. We will use that and we'll ignore the furlough. But we're also looking at our product range. We're also considering, do we need some different products? So should we be looking at for people who have had credit blips during the furlough period? Do we need payment holiday products? Those kind of things, because we're just trying to think about how will customer needs have changed come July, August, September, and do we need to adjust our product range accordingly? So very conscious that this is a very difficult, different period. We're trying to react as fast to that as we can, and the key thing for us is to try and find the fairest, most transparent approach for brokers and customers that allows us to continue to lend throughout this crisis, which we are very committed to doing. So thank you. I'll now go on to the 5 questions we've had submitted. We did have many questions, most of which we've tried to address as we've gone through the slides. So we'll just go through these 5 questions briefly. So I'll hand over to Alex for the first question.
Yeah, so the first question is around forward expectations for interest rates. I did talk briefly about the Bank of England rate. I think in the next couple of years, I'd expect interest rates to stay low, and say that's consistent with what the market expects. I think further out it gets more interesting because at some point the UK government and all the other governments have to deal with the significant amount of quantitative easing which is being undertaken. I think the Japanese QE program was talked about 20% of GDP on the news yesterday, and a lot of the quantitative easing from the financial crisis is still kind of outstanding. So one of the typical ways that governments deal with this is through some increased inflation and effectively inflating their way out of this debt burden. So far, the forward expectations for inflation are not sort of implying that, but it could well be that if people expect inflation to increase in the sort of the medium term, and by that I mean sort of say 5 to 10 years, then interest rates could go up in the longer term. So with that, I'll hand over to Craig for the second question.
Yes, thanks, Alex. So a question we've had, why have some lenders cancelled cases that haven't been offered or completed, and other lenders allowing them to remain on hold? So I'll firstly just talk about what Kensington have done. So what we've done is, if your customer is post-valuation, we are absolutely continuing on as normal. So we have the valuation, and that's whether they were the high LTV products that we've since withdrawn. We will continue to go through that process through to offer, through to completion. Clearly the completion may be at a different time, or there may be an offer extension that may be appropriate depending on the customer's circumstances. But what we have done is we've looked at the products we think we'll be able to continue to take all the way through the pipeline from app to completion when we get our new desktop AVM solution in. And if we have customers in the pipeline which are pre-valuation, so have not yet had the valuation, and we don't think we can do those products, such as new build, for instance, where we know we're not going to be able to do those until we get physical valuations, we have cancelled those pipeline cases. So there's a few customers that have been affected. Some people have taken that approach, as some people have cancelled all the way up to pre-offer. We've tried to basically look at our cash position so we can understand what's real in the pipeline and what isn't. And also, I think from a customer perspective, I feel it's the fairest thing to do, because I'd much rather have a difficult conversation with a broker now explaining they've cancelled their case, which isn't great, and I understand that, rather than 3 months' time say to them the property's been devalued, the customer's had a change in circumstances, we're not lending on that product currently, and the customer's been waiting for 3 months when potentially that customer could have been placed elsewhere. So for me, it's a bit of short-term pain for a longer-term gain, I hope. The other thing I'm uncomfortable with is sitting on £300 of a customer's money where they've given us a valuation that's not going to go anywhere for months, when I think in the current environment, cash is king for customers. So I don't want to take any of their money that I shouldn't be holding on. So that's how we've approached it. Other people are different. Some people have kept their pipelines open and they're just sitting on the side for several months. But that's kind of how we've approached it. Alex.
Yeah, so the third question was around support for the non-banks. I think for the Treasury is supporting the specialist lenders that have banking license, but their plans for the non-bank specialist lenders, I think, is probably a question for them. I would say the Australian model is probably the best example of a number of foreign models for this, and the Australian QE scheme actually just bought the RMBS issued by one of the specialist lenders over there called Firstmac, and stepped in to sort of really take the place of the public investors. And we saw the Australian government be very supportive after the financial crisis as well. And as a result of that, their non-bank specialist lender has been very healthy for a long time. So fingers crossed something like that comes to the UK market as well. Great,
thank you. And then the question I've got, so when lockdown's over, will you return to your standard policy immediately? For example, maximum LTVs. And I think the answer to that is no. I think just as all the signs from the various governments around the world are that there will be a gradual unwinding of lockdown, which seems to be the initial view, certainly in Austria, Sweden, and Italy, where they're actively looking at that. I think we'll take a similar approach. So I think we'll expand our volumes and our product range gradually. I think some areas will see a big increase in demand. Things like new build, where there's hardly any new build being done at the moment. That most of the new build sites are closed. There's no salespeople. There's very few applications, and most applications can't go anywhere. So I think that will go from kind of 0% up to maybe 70% very quickly. So that's a big jump that you'll see. But then other areas such as standard remortgage and purchase will take a bit longer to get back to normal. I do think there'll be some people who've lost a bit of confidence. There'll be some people whose circumstances have changed, so can no longer move. I don't think we're going to get back to our normal run rate in the market and normal Kensington run rate in the full product range for some time. I think it'll be a gradual easing in line with customer demand, and also, there is a lot less brokers in the market currently than there was previously. Hopefully that will get back to a normal rate, but again, that may take time, or we may not see the same amount of broker supply as we had previously. Alex.
Yeah, so the final question comes around basically what mortgage rates will do after we sort of get through this this phase. I think there's been a lot of pressure from government to pass on the benefits of the TFS and the rate reduction. So I think sort of banks and non-banks will will try to pass that on. At the same time, I think they will have to consider their credit risk expectations and what the impact on on the broader economy will be of this this enforced recession. So really difficult to say, but I do think net probably rates will be mortgage rates will be slightly higher, certainly for the 2 and 5 year fixes after this. And I think what we'll probably also see is a steepening of the curve across the credit risk profile. So what I mean by that is that over the last 5 years, we saw the rate difference between a 75 and 95 LTV product, for instance, to compress quite significantly. I would expect that to make quite a rapid jump back out again. So at lower LTVs, probably very little impact. At higher LTVs and for more idiosyncratic risk types, I think it's going to be quite a substantial increase in rates. Back to you, Craig.
Brilliant, thank you, Alex, and thank you all. Very much appreciate the several hundred of you who have joined this webinar. Apologies, it took significantly longer than the 30 to 40 minutes I quoted at the start. There's just so much to get through. We have done this in response to the many questions we've had from the brokers in the industry over the last few weeks. Very interested in your feedback, so please feel free to respond through your BDM, through LinkedIn, sending us an email. Very interested in, has this been worthwhile for you? Is there anything else you think we should be discussing over the coming weeks? Is there things we've missed out? Is there things you're surprised about? So very interested in that. But thank you very much for your attention. Really appreciate it. Let's keep talking. I wish you all a peaceful and calm Easter. Hopefully you'll all get some good time with your family over the next few days and the weather holds. But we will end it there. But thank you ever so much.